Thanks for listening to the Discount Property Investor Podcast. If you enjoyed this episode, please like, share, and subscribe to help us reach a wider audience. To jumpstart your real estate investing career, please visit freewholesalecourse.com, the most complete free course on wholesaling real estate ever. We would also appreciate it if you left us a review on iTunes or Stitcher. Thank you in advance for your support, and remember, you make your money when you buy, and you get paid when you sell. Now let's go build some wealth.
You're overthinking it, man.
All right, guys, welcome back. This is the Discount Property Investor Podcast. I'm your host, David Dodge, with co-host Mike Slane.
Hey, guys. Thanks for joining us today. Super excited to be recording with Dave. This is one of the things we like to do. We don't have enough time for it, seems like. We get out there and look at properties, and that's fun too. But, you know, it's nice to get in here and chat about real estate with one of my partners. I enjoy doing it. And
yeah, me too.
I'm happy to be here today. So hopefully you guys are killing it in wholesaling. This is a Discount Property Investor Podcast. Like Dave said, we focus primarily on teaching people how to get started in real estate investing. And the first way is through wholesaling. That's what we always recommend. It's a great way to learn your numbers and then, you know, get your feet wet in this investing business without having a ton of capital.
It's true.
So it's, again, a great way to get started. Today we're talking more about rentals. We're going to continue our little series on the BRRRR strategy. And today we're talking about what to buy, right? Isn't that kind of what we're going to delve into?
Yeah, so last episode we talked, how to buy rentals, essentially. We kind of gave you a big picture on how to buy. So today we're going to dive into the what to purchase a little bit deeper.
Awesome.
So we talked about location, we talked about the city and county rental laws, and, research your market to pick the area that makes sense for you. So we're really going to dive into that today. So we are obviously out of St. Louis, Missouri. If you've been listening, you should know that. And let's talk about location, Mike. So we have rentals in our city. They are located in the North County region, and they are located in the South City region primarily. We have some sprinkled out in other areas. Why do we have most of our rentals in those two areas, though, Mike? Why is that location matter for us?
Absolutely. So that's a great question, and I'll even expand it a little bit further on why it makes sense for other people too.
Okay.
So we invest in those two particular areas in St. Louis because the numbers work. We know our numbers.
Know your numbers.
And we can make cash flow in those areas.
It's proven because we were doing it. So doing one on a street nearby is going to be simple versus trying to go somewhere that we know nothing about.
100%.
Location.
Yeah, and it's not to say you can't make it in other areas of St. Louis. Absolutely you can. These are the areas we're having success with, so we're putting our money there.
Correct.
So why does it make sense? Because we can get a positive cash flow or return on our investment in that area. So what you're going to do if you live in let's just call it an expensive market versus a less expensive market. So if you look at like the West Coast, so California, they've got, in our opinion, because again, we're Midwesterners, they've got crazy expensive real estate out there, right? So, I mean, you're looking at $500,000, 2-bedroom, 1-bath little bungalows or whatever. That's not how we live here. And that type of property wouldn't make sense to buy as a rental in most cases. Again, to come up with the money to buy a $500,000 house is going to be a lot harder than to come up with the money for a $100,000 house. And the rent, again, I'm not exactly
Isn't going to be 5 times.
I don't suspect it's 5 times. That's the big problem.
Right. It's going to be 2 or 3 times.
Right. You're
5.
probably going to be paying $3,000 to $4,000 a month. You also, in some places like New York, you've got rent controls. And again, I'm not super familiar with it. But you can't increase your rent over a certain level. So it causes all sorts of issues. Same thing with San Francisco. You can't build. I'm digressing. Get back to focusing on the fact that we like the Midwest. You should look for regions that make sense to invest in from a cash flow perspective. So what does that mean? It means that you've got to look at the purchase price, figure out what you can finance properties for, break down what your monthly payment's going to be, figure out your taxes, insurance costs on it, and your estimated rents.
That's it.
So
that's all you need.
You're gonna look at those those numbers.
And you want to have an
find out.
estimated cash flow, which is basically all the money that comes in. It pays all your expenses and there's some left. That's the cash flow. So you want to have an estimated cash flow of at least $250. Why? Why does it need to be at least $250? Well, because you're going to have vacancies and you're going to have maintenance and you're going to have management expenses. So if you want to make it be profitable and actually turn this into a business and not a hobby, you need to have at least $250, because there's going to be periods of time when it's vacant and you have no money coming in. So you need to have cash flow, extra money saved to cover the mortgage in those months. You also are going to have expenses of dealing with things when they break, and you're going to have to pay somebody to manage it, or you can manage it. So that third expense may or may not be there. But as you scale, you are going to have to pick between managing all your properties or hiring a manager. So there will be a cost at some point with that. Wouldn't you agree, Mike?
Oh, absolutely. Yeah. So we use a property manager. We've gotten to the point where we need someone else to help us.
Well, that, and it's hard to do both. You can't be in acquisition mode and management mode. So we'll, maybe at some point we'll open our own company. Who knows? But right now, it works great for us to have somebody help with the leasing and the day-to-day management and rent collection, because we are focusing our efforts on buying more.
Absolutely.
We're using the burst
It's a
strategy.
full-time job just managing
Acquisitions.
Properties. 100%.
Right.
100%. So, okay, so we're talking about what to purchase. Let's circle back again, and we kind of talked about the location, why we think the Midwest is a great area to invest in. The type of property, let's touch on that a little bit. We like single-family homes, right? So single-family homes have been one of the traditionally best things to invest in. I think it's been a 6% return from the 1960s to I think prior to the bust or so. Yeah. And then again, obviously after that, prices started climbing again slowly, and we're now
6% a year. That's pretty awesome.
Right, and that's
Pretty awesome.
Yeah, inflation adjusted, all that. So it's pretty good stuff.
Well, Michael, last episode we had mentioned, that you had a friend who had a strategy on buying, one bedrooms, and we don't. Our strategy is the opposite of that, but that's okay. That particular person had picked a niche. However, we do own one bedrooms in a multifamily setting.
We do.
So there's a big difference between a single family rental and a multifamily rental. With multifamily, you get to dollar cost average the cost of all of those items by the bedrooms. We talked a little bit about that in the last episode too. So if you have one roof with 10 individual units, that's one bedroom units, that changes a lot of things.
Yeah,
we
that's a good
actually
point.
own a 10 family that has one bedroom units, but it's one roof. So, type of property has a lot to do with, what kind of investing or investor you want to become or do.
Absolutely. Absolutely. Yeah, and that's
And that might be a cash flow play on a multifamily unit. However, the pros and cons of multifamilies versus single families is the barriers to entry obviously are going to be higher typically when you have a multifamily, because you have a lot more plumbing, a lot more electrical. The cost is going to be higher. One of the major cons, in my opinion, is the liquidity of those deals. Single family houses are going to be very easy to sell because you have a lot of buyers out there that are looking. You have people that are wanting to buy to just move into. You have investors, so on and so forth. Well, with multifamily investments, typically the owner of those buildings don't live in them. It's always going to be an investor whenever you're dealing with larger properties. A duplex, maybe not. Maybe you have somebody that wants to move into a duplex and rent out one of the sides, but it doesn't really happen that way when you get up to 4, 6, and 8 families, so on and so forth. So type of property is something that you want to kind of, figure out what works for you. And if you're just getting started, we recommend sticking to single families. They're easier to manage, and they're easier to kind of work the numbers on if you're a beginner.
Yeah, and I think it's probably easier to get a loan on them. Honestly, I think that, a bank is going to have more comfort with you taking on that type of risk versus a
good
multi.
point.
But again, it just kind of depends on your experience level.
Absolutely.
Excuse me.
So figure out what kind of investing you want to do. Stick to it. Love that. We talked about basements and garages pretty in detail last episode, so we'll push past that. Mike, next, I think, when it comes to what to purchase, the price. Okay, everyone's always going to be thinking, well, what do I look for in terms of price? Well, that depends on you, but the purchase price is very, very important. Wouldn't you agree?
Oh, it's probably one of the most important things.
Absolutely.
I mean,
so this kind of circles back to know your numbers. And maybe you determine your purchase price by looking at all your other numbers first. That's okay. You can first say, okay, I think in this particular area, I can get this rent, okay? Well, typically in our area, we need to be at 1% of the purchase price in rent. So if I'm looking at a property and I'm like, I think I can get $900 a month in rent for this. Well, the absolute most I can be into this property for is 90 grand. The absolute most in my market. And your market may be a little different, but it's a great rule of thumb. It's called the 1% rule.
I love that one. So, and that's I love that we talk about the purchase price, because I was just thinking of that kind of saying. There's three things in real estate, and there's really only three things: the price, the location, and the condition. Right? So you can't change the location. I mean,
Can't change that.
But you get to pick all these things, though.
Right.
That's what's cool, is up front, before you buy it, you're picking all these things that you want. And you say, well, I don't really pick the price. Well, you do. You pick the property, and then you get to negotiate the price.
Right.
So again, it's pretty neat stuff. So price is very important, but it's going to be based on the rental income in your area. So you have to determine, again, if it makes sense in your area. Is this purchase price going to be supported by the rent? Does the rent cover?
And is there a demand for renters in that area?
Very good. Yeah,
Absolutely.
very good point.
So one thing that we didn't touch on very, very in detail last episode was the condition. We mentioned it, but we're going to really dive deep into the condition.
This is important.
This is very important. So if you're new to rental investing, location obviously is very important. The amount of rent is very, very important. And then, of course, knowing what you're looking for, type of property, bed, bath count, having metrics in place. Next is the condition, okay? The condition is going to change a lot of things because this can affect how much you can offer on the property. So whenever we look at a property, we start with the end number in mind, okay? We use a simple formula called the MAO formula, and basically what it says is I can offer this amount of money for a property based upon what it's going to be worth once it's fixed up or rehab to a rent quality, okay? Multiplied by a discount rate, which we're going to get into as well, but that can change, minus the repairs. So the repairs are basically the thing that's going to change the most. If I'm going to look at every house on a street and they're all 3-bedroom houses, I can essentially assume that the after repair value of all of these houses is going to be relatively the same.
Yeah, it's pretty similar. So that's what is a very good example. We were actually analyzing a property this morning, and we looked at one on the same street a couple weeks prior. And we said, oh, here was our number on this one. Well, our number probably is going to be pretty similar on this one. This street, it's all they're all about 900 to 1,000 square foot houses.
2-bedroom, 1 bath.
1 bath, very small. Some have garages, some don't. I mean, that's pretty much all you've got on this street. So
that's all you need to know, essentially.
Location's the same. The
ARV is the same.
The ARV is going to be the same, so our after repaired value. But the condition,
The discount rate will be the same because of the location. But the condition is the one thing
condition-
that varies from house to house.
and that's, I think, what most people struggle. So the condition is going to affect, though, that other variable price. And those two are very intimately tied together. So
They're
that's
intertwined.
something that takes a while to get a real handle on.
So let's review our formula. What's the most I can pay for a property? Well, it's based on the condition. So the formula is your MAO, your max allowable offer, equals your ARV, or the after repair value, multiplied by 0.7 or 0.8. It's a discount rate depending on your area, minus those repairs. Okay? So yeah, love it, Mike. So the condition is going to vary greatly from property to property. So if the condition is move-in ready, well, that is not really that big of a deal in the equation. However, if that property needs $10,000, $20,000, sometimes even $30,000 worth of work in order to get an occupancy permit so you can rent it, well, that's going to decrease your offer by $10,000, $20,000, or even $30,000, which is going to be equal to the amount that you'd have to spend to get an occupancy ready.
That's the beautiful thing about wholesaling too. Is, David, if you
They're
kind of
intertwined,
followed,
yeah.
Well, if you followed with us along, you started learning your numbers by wholesaling properties. You went out and you've made offers on properties. You've got some under contract, and you start marketing to other investors. And other investors say, "Oh, no way, your rehab number is too low. That $20,000, you think I can rehab a 2,000 square foot house that needs a new kitchen, 3 new bathrooms for $20,000? You're crazy. And that might be true. Again, you're going to learn your market by doing some of that wholesaling. So the condition is the biggest variable. We highly encourage you to get out there, network, and do some wholesaling to help you network and learn and sell properties and find out what a good deal is in your area to get started. That's why I just love the fact that that's where we both kind of started from. We knew we wanted to do rentals and started wholesaling here in St. Louis and started picking up quite a few more. And yeah, it's really fun, guys. It gets to be fun.
Absolutely. So the rehab estimate is really what we're looking for whenever we talk about the condition. How much is it going to cost to fix that property up? So that way we can use the rest of our formula to determine how much we're going to purchase the property for. So the purchase price, I'm going to go out on a limb here and I'm going to say that is it is the answer to a problem that we're going to solve. Basically, we're going to use an equation to determine what that purchase price is every single time. It's a variable that's going to change based upon the condition of the property. And then last but not least is the rehab plan. So we're going to want to put a plan in place once we determine the condition, so we can get that property fixed up and ready to be leased out.
And we're going to go way into depth on that one when we talk about rehabbing. So we'll go into all sorts of different ways to estimate repairs and figure out what your rehab costs are going to be. So
I love it.
Yeah.
All right, guys. Well, until next time, that was an episode on what to purchase. Wanted to get in a little bit more detail about that. Thanks for listening. Again, check out freewholesalecourse.com if you haven't been there already. And we wholesale and buy rentals. So we're using, we're basically keeping the best, selling the rest. We encourage you to do the same. Wholesaling is a job. It does require a lot of work. So put that work to use by buying rental properties so you can actually make money while you sleep. All right, guys. Thanks for listening. Until next time.
Welcome back to Season 2 of the Discount Property Investor Podcast. Our mission is to share with you what we have learned from our experience and the experience of others to help you make more money investing like a pro. We want to teach you how to create wealth by investing in real estate the Discount Property Investor way. Make sure you never miss an episode and download the Discount Property Investor app in Google Play or iTunes today. To jumpstart your real estate investing career, visit freewholesalecourse.com, the most complete free course on wholesaling real estate ever. Thanks for tuning in.